Let's start with buying a car outright. This means paying the full price of the car up front. No loans, no monthly payments, no interest. Sounds great, right? Well, yes and no. Pros: no monthly payments. No interest charges, full ownership from Day 1, you can sell the car anytime, lower insurance premiums in some cases. Cons: huge cash outflow up front. May limit your liquidity, less cash for emergencies or investments. Risk of high depreciation, especially with new cars. Example: let's say you buy a car for $30,000. That's $30,000 gone from your bank account immediately. But in 5 years, that car might only be worth $12,000 due to depreciation. So while you avoid debt, your money is tied up in a rapidly depreciating asset. Section 2. Financing a car. 2 to 30, U5. Host. Next up, financing. This is the most common way people buy cars. You pay a down payment up front and borrow the rest from a bank or dealership, then pay it back monthly with interest. Pros: smaller upfront cost-build credit history with on-time payments. You own the car once the loan is paid off. More flexibility in choosing the car you want. Cons: interest increases the total cost of the car, risk of negative equity. Owing more than the car is worth. Monthly payments can stretch your budget. Example: suppose the car is $30,000. You pay $5,000 down and finance $25,000 at 6% interest over 5 years. Your monthly payment is around $483. Over 5 years, you pay nearly $4,000 in interest, so the car costs you $34,000 in the end. Still, it spreads the cost over time, which can be easier to manage. Section 3. Leasing a car, 5-7-30. Host. Now, let's talk about leasing, which is essentially long-term renting. You pay a monthly fee to use the car for a set period, usually 2 to 3 years. At the end of the lease, you return the car. Pros: lower monthly payments compared to financing. Drive a new car every few years, lower repair costs, under warranty. No hassle of selling the car. Later cons: you don't own the car. Mileage limits, usually 10,000, 15,000 miles, year excess wear and tear fees. You're always making payments. Let's say you lease the same $30,000 car for 3 years. You might pay $350 a month with $2,000 down. Over 3 years, you spend $14,600, but you walk away with nothing to show for it. It's perfect if you want a new car often and don't want the responsibilities of ownership. Section 4. Which option is right for you? 7:30-9:30. Host. So, which option is right for you? Let's break it down by different situations. 1. Buy. If you have the cash to spare. You want to keep the car long-term. You want 0 monthly obligations. Finance. If you want to own the car eventually. You prefer to spread out the cost. You're okay with paying interest for flexibility. Lease. If you want to drive new cars every few years. Scene 2. Buying a car, 2,000 characters max. Title on screen. Buying a car is paying cash. Really the smartest move? Script. So let's start with the most obvious option. Buying a car outright with cash. It sounds like the smartest move, right? No loans, no interest, no monthly payments. And yes, if you have the money, it can be a great way to avoid debt. But let's break it down financially. Imagine you pay $25,000 cash for a brand new car. The second you drive it off the lot, it drops in value by about 10-15%. After 1 year, it's worth maybe $21,000, and you've locked up all that money in something that's losing value every day. That's called depreciation, and cars are experts at it. And here's what most people don't think about. If you'd invested that $25,000 instead into a decent index fund, let's say you could potentially earn 7 to 10% per year. So yes, buying with cash saves you from paying interest, but it also comes with an opportunity cost, the money you could have grown elsewhere. Also, if that cash is your emergency fund, spending it on a car could leave you vulnerable. One medical bill or job loss, and you've got no cushion. Bottom line, buying is best when you already have a strong emergency fund. The car is fairly priced or used. You want to avoid monthly obligation. 3. Leasing a car, 1,500 characters max. Title on screen. Leasing, smart flexibility, or expensive trap. Script. Leasing sounds tempting, right? Brand new car, low monthly payments, no huge upfront cost. But here's the truth. Leasing isn't for everyone. When you lease a car, you're essentially renting it for 2 to 3 years. You don't own it. You're just paying for the car's depreciation during that time. The benefit? You're always driving something new, usually under warranty with lower repair costs. The downside? There are strict mileage limits, usually 10,000 to 12,000 miles per year. Go over that, and you'll pay expensive per-mile penalties. Also, at the end of the lease, you walk away with nothing. No equity, no trade-in value, and if you want to get out early, expect early termination fees. So, who should lease? Leasing can be smart if you drive a predictable, low number of miles. You like upgrading cars frequently. You want lower monthly payments on screen. Financing a car, freedom or financial trap. Script. Now, let's talk about financing a car, probably the most common option today. Financing means you take out a loan, usually from a bank or dealership, and pay off the car over 3 to 7 years in monthly installments. It feels doable. Smaller payments, you get to keep the car, and eventually, once it's paid off, it's all yours. But here's where things get tricky. First, interest adds up fast. Even a 6% loan on a $30,000 car over 6 years can cost you over $5,000 extra in interest. Second, you start off upside down, meaning you owe more than the car is worth, especially in the first couple of years. That makes it hard to sell or trade in early. And don't forget insurance. Most lenders require full coverage until the car is paid off, which means higher monthly costs. Financing can make sense when you don't have enough cash to buy outright. Plan to keep the car long-term. You get a low interest rate and a reasonable loan term. Just avoid loans that stretch too long. A 72 or 84-month loan may lower your payment, but it traps you in a long-term commitment while the car continues to lose value. And always put something down. 10% to 20% is ideal. It reduces your interest and protects you from being upside down. So, is financing bad? No, but it's only smart if you understand the full cost, not just the monthly payment. Scene 5. Which option is right for you? 2,000 characters max. Title on screen. Buy, lease, or finance. What's the best choice for you? Script. So we've looked at buying, leasing, and financing, but how do you know which one is right for you? The answer depends on your budget, your goals, and your lifestyle. Let's break it down. Buy outright best if you have strong savings, don't like monthly payments, and plan to keep the car for 7 to 10 years. Pros. No interest, full ownership, long-term savings. Cons. High upfront cost, ties up cash, risky if you don't have an emergency fund. Lease, great for those who want a new car every few years, drive low miles, and want lower monthly payments. Pros. New car. Warranty coverage, low payment. Cons. No ownership, mileage limits, penalties for wear or early exit. Finance ideal if you want to own the car but can't pay cash up front. Pros. Builds equity, flexible terms, you keep the car. Cons. Interest adds cost, higher insurance, long commitment. So, what's my advice? As an accountant, if you value ownership and drive long-term, finance or buy. If you prefer flexibility and low maintenance, lease. Just do it wisely. And no matter which you choose, always run the numbers. Don't just fall for the lowest monthly payment. Look at the total cost over time. This isn't just about getting a car, it's about making a decision that fits your financial future. Here's one more thing to think about. Your future goals. Planning to buy a house soon? You might want to keep your debt low, which could make leasing a smarter short-term move. Starting a family. Financing a reliable, long-lasting car might make more sense than switching vehicles every few years. And if you're young, just starting out and want flexibility, leasing or buying a used car with cash could help you stay debt-free while building credit. The truth is, there's no one-size-fits-all answer. But with the right mindset and a little financial planning, you can choose the option that protects your wallet and supports your lifestyle. Whether you lease it, loan it, or own it, make sure it's a decision you've made with your head, not just your heart. Don't forget to hit like, subscribe, and turn on the notification bell for more smart money tips from an accountant's perspective. You don't want to worry about resale or repairs. You drive low to moderate mileage.